when you make a wrong decision, how does it impact you? And as you know, I always like to use a holistic financial plan to measure, to illustrate the impact of the mistake. So let's look at the case of Rocky. So initially, in the beginning, Rocky has got current financial goals. He intends to retire at 55 years old, and he just only need to provide for about 6,000 per month, 72,000 a year living expenses when he retire. And he want to provide 200,000 for the two children that he's got for their tertiary education. He's 36, the wife is 34 years old. Their combined income, husband and wife, is 220,000. And currently they're spending about 96,000 per year. Okay. And 1 year, they pay about 12,800 premium for life insurance. Life insurance, not other insurance. Okay. And they have a house, they're saying now they bought it about 500,000. And now, at the same time, they're having the mortgage of 250,000. They have invested some money into unit trust fund, bond 30,000, balance fund 200,000. Okay. And then EPF, he has got 200,000, wife has got 150,000. So as it is, if we do an asset allocation for him, we will see his average investment portfolio return is about 7.48%. Not too bad, you know. Of course, ideally, we hope to achieve 8% or 9%. But 7.48% is enough to beat inflation. Is enough to help you to achieve, to grow your asset as well. So that's quite good. But you see, the better way to understand where Rocky stands is to plot a holistic financial plan for him. So if you were to look at his holistic financial plan, we can see that, wow, his wealth, from where he is now, is projected to continue to grow, and then at peak at almost 6 million. And then when he retire, then it will start to continue to drop and finish by the age of 84, which is very good financial position, very strong financial situation that Rocky is in. But in life, there are so many temptations. There are a lot of noises. There are a lot of suggestions, and that may somehow make us take certain action that eventually may not benefit, may not improve, but actually may damage the financial security that you already have. Okay, let me share with you further. You can see here. Let's look at how Rocky started to make mistakes. And these are mistakes, if you notice, are all very small mistakes. And how this small mistake impact his financial life. Number one, he was approached by a good friend to buy more life insurance coverage. Actually, but as it is, he has got enough insurance coverage to protect himself and his family already. But due to the persuasion of this life insurance agent, and this life insurance agent is very persuasive, a good talker. So Rocky think, why not? I can afford anyway. So he actually increased the premium for himself, buy some additional insurance policy that now increased his insurance premium from 12,000 to 22,000. So is it fatal? Is it serious mistake? Not really, because he can still afford. He won't feel it at all. No, so he can afford it. Next, he's been spending 96,000 per year, but then along the way, he find, hey, maybe I should save less and enjoy myself a little bit more, because all my friends now, they are like, eating out more, or maybe buying more expensive items. I think I also deserve it also, right? So bang. So his income increased, his expenses increased by 1,000. The income increased 1,000 per month, meaning the saving reduced 1,000 per month. Then this unit trust investment that he has got has been giving him about 7 to 8%, sometimes 9%. But to him, this is very boring. The returns quite low compared to some of the friends investing to say that, oh, I got 20%. I invest in the stock, I make 50%, or some even make 100% kind of return. So Rocky cannot resist the temptation, So he said, maybe I should do something about it. So he sell this unit trust, take the money, 200,000, and invest in the share market like his friends. But he's not as fortunate as his friend. He didn't make that much of money. In fact, he ended up losing money. He lost 60,000 out of the 200,000 that he has got. That is about 30% of his capital. Those of you who invest in share market, you will know that this amount is really, this type of loss is actually quite common in share market. So when he lost money in the equity market, he feel very frustrated and very disappointed. He said, okay, I don't want to do anything. I don't want to invest already. I think I must well put this money in the bank. Then I won't lose money anymore. So he decided to put all this money into fixed deposit. No more in unit trust anymore. So the money never go to unit trust. The money go into the bank, fixed deposit. And that's not all. The house that he's staying, he think that maybe he deserves to upgrade his house now, because this house has been staying for the past maybe 7, 8 years already. So he want to upgrade the house to give a better living quality for the family. So he bought a more expensive house, not too expensive, 800,000. So and then he got the mortgage also increased, even though he sold the house, and then it's a down payment also increased. So again, spend some money to do renovation, move in. Okay, so the mistake, the impact, we can't really feel it, but basically so far you don't feel anything wrong. But you see, with all these changes here and there, money move here from one account to another account, one bank to another account, the average investment return portfolio now is no longer 7.48. It has now become 3.75. And what is the impact? Okay, let me show you the impact of one mistake at a time. When he overpaid life insurance premium unnecessarily, his wealth, instead of lasting at the age of 83 years old, okay, his wealth now lasts up to 79 years old. That is 6 years faster. And then when he reduced his saving, remember, 1,000 per month, again, nothing major, but you can see his wealth from 79 years old now can last him up to only 72 years old. Okay, this is quite serious. The wealth dropped a lot. And when he invests in share market, lost the money and put money in the deposit, remember, that the wealth lasts now from 72 years old to 70 years old. And when he put the money into FD, from 72 years old, 70 years old, now can last only to 66 years old. And when he bought a house, got a bigger loan, then from 66 go to 64. So you can see a series of all small, insignificant mistakes combined together has got an avalanche impact on his financial life. If we compare of how much net worth that he has, he's supposed to have 3.1 million. But now, with all these mistakes that he made, he end up having 2.4 million less at the age of 55. That's why now his wealth can only last him, if he retire at 55, can only last him up to age 64. So I stay in this industry long enough. That's why I get to see a lot of impact the impact of a lot of unnecessary mistake, which one lead to another and eventually compounded to become a big mistake. So in a rocky situation from someone who's financially comfortable, secure, financially free, but he's not careful in certain years, make some small mistake, eventually become financially not so successful, financially struggle or stress. So that's why never underestimate the action that you take. Always make sure the action that you take is well considered, always fit into your ability, fit into your financial plan.